Hello fellow investors! Today's video commences a new section on the channel which will be related to general finance topics and basic advices for those considering to enter the investment path. Since the video is a starter for a new section, I will try to make it tasty and light. Today we will discuss the leading metric investors use to compare different companies or investment efficiencies. This metric is TSR. Let's picture this scenario. You are faced with comparing the performance of two companies to determine the superior investment option. The companies are from the same industry but in diverse geographic locations. To complicate matters, one is a well-established classical company, while the other is a promising newcomer. Making a decision in such a scenario is no walk in the park. Now, let's simplify the challenge. By needing to compare not just two, but 10, 20 or even 100 companies, the complexity multiplies immensely. This is the exact situation where TSR steps in. Now, what on earth is TSR? Think of it as an ultimate performance metric, the comprehensive scorecard that tells the complete story of an investment. TSR combines the impact of capital gains and dividends generated by the investment. It is the first metric you must look at when comparing the companies, and it is a financial metric measuring the total return a shareholder has received on an investment, including capital gains and dividends. It is calculated as the change in the stock price plus dividends paid divided by the initial stock price. For instance, you purchase one share of company X for $100. 1 year later, the price of the stock increased by 8%. Also, over this period of time, the company paid $5 in dividends. Overall, you received in your hands only $5, which is a 5% return over your investment of $100, but the total value of your position increased by a higher amount, and it did it in line with TSR, which is $8 plus $5 divided by $100 or 13%. So in simple terms, you managed to generate 13% over your investment. It is important to understand that a portion of your profit, which is related with the share price increase, is not realized, and you will be able to lock it only if you decide to sell your share. But as we all know, investment is not only about the cash on your bank account. It is about the value of your investment positions, which you convert to cash only from time to time. As any simple solution, TSR has its pros and cons. Let's start with the pros. First of all, this metric is extremely intuitive. TSR value immediately gives you an understanding of whether the company performed well over time. If you compare TSR of the target company with the market standard growth, you will immediately be able to see how attractive the company is. Second benefit of TSR is that it is easy to find. Look only at the company's financial reports, investor relations website or financial news platforms, and you will immediately find it. The third benefit of the metric is that it has a wide range of applications. TSR works both with classical companies and with fast-growing ones. Certainly, you cannot analyze the unicorns of the market whose growth is mainly driven by investors' emotions. However, it is a good tool for initial analysis. In financial investment, like in every other domain of our life, there is no ideal tool. And here are some disadvantages of TSR. TSR can be influenced by short-term market volatility, which may not accurately represent a company's underlying performance. Short-term fluctuations in stock prices can lead to misleading TSR figures. If market faced some kind of shock, or a target company went on IPO a few weeks ago, TSR may not be the best tool to assess its performance. Another weakness is dividend dependency. TSR heavily relies on dividend payment, which may not be consistent across all companies. In cases where a company does not pay dividends, TSR may not fully capture the return for shareholders. This is specifically applicable for IT companies such as Amazon, Google, Apple, and similar ones. It is important to understand that TSR is a high-level metric, and it doesn't provide detailed insights into specific internal metrics such as profitability, efficiency, or operational improvements. And the last important element I would like you to pay attention to is the potential M&A impact. If a company engages in any kind of merger and acquisitions, TSR can be influenced by these activities. The impact of M&A on TSR may not always reflect the success or failure of these strategic moves. In a nutshell, TSR is an excellent tool to evaluate the performance of the companies. It is easy to understand, widely available and applicable to both classical and fast-growing companies. However, it has its limitations and should be used with other financial metrics for more comprehensive analysis. Thank you for watching.